Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Thursday, August 4th, 2022. I'm going to go over some existing trade ideas as well as a couple new ones, and I'm going to do them in this order. Very brief update on the equity markets. I usually start there, focusing mainly on QQQ and RTY or IWM, the small caps, and the Russell, the Russell 2000 small cap index, and the Nasdaq 100 tech heavy index. New trade ideas on the hooved creatures, lean hogs and live cattle. And there's an ETF there for you that holds both. Lumber, I want to do an update there. Pointed that out yesterday. It's starting to set up. So I'll do a quick update and then updates on natural gas, crude oil, and time permitting the metals. All right, let's start out here. QQQ again from way back here, pivoting off those lows on June 16th, had a max, pretty much still is a max bounce target of more of a range. It's the downtrend line, the primary downtrend line right here on QQQ, as well as the 200-day moving averages. Now the exponential 200-day moves faster. It's the red line, so it's going to come in quicker during a downtrend. And the 200-day simple up here is the slower of the two. And you can see there's some price resistance that comes in there as well. And so it's more of a range, but I told you guys that to me this was a trend trade here. Swing trades are these right here for the most part. Trend trades are, you're capturing a move. It's been a 20% or so rally in the Nasdaq 100. And so I mentioned, long-term accounts, especially those that you don't have a lot of flexibility because of trading restrictions like 401k. Well, I moved that in. And then I started to, I believe I told you right here, I took half off, but just yesterday I took the remaining half off there, and it closed out just about all longs and started even taking a little starter, nibbling at some starter hedge positions in short futures. Interactive brokers. I don't know about the other ones out there. They let you. Most people don't realize you can't short stocks in an IRA, but you can short futures, which is a great thing. You've got both the leverage and the ability to go long or short. Of course, you can buy inverse ETFs and IRA accounts. And again, at the end of the day, if you don't know what you're doing, if you're new to this, don't trade in your IRA. That should be an investment. Maybe go to cash. I wear multiple hats, but that's that. Just want to let you know we're close enough. I would rather leave this on the table. Even this is just my trading style. So I milked, the bulk of almost all the meat off that bone on the longs on those trend accounts. And like I said, to me at this point in time, it's either neutral to a net short position, and I'll continue to add into those shorts, and even did this morning. So, all right, that's that. The other things that you should be aware of on the Nasdaq 100. Fib clusters, Fibonacci clusters, that's the all-time high back in November, the Nasdaq 100 down to the low. That's this orange line here. You can see the fibs are here, 50%, 38.2. And then I also have this major reaction high. We had a bear market rally back then in March, and that comes in. So right there, hopefully you can see it in the video, those two lines come in. It's a Fibonacci cluster, two major reaction highs, the 38.2% Fibonacci retracement of the entire leg down off the highs, and the 50% retracement off this second leg down or from that major reaction high. So you've got price resistance coming up. You've got Fibonacci cluster right there, meaning dual fib levels. I can show you that on the Nasdaq 100 futures. And so despite the current trend, it starts a little messy. Let me move it here. Let me move these annotations. What this is, I have dual fibs here as well. It looks a little busy. These are Nasdaq 100 futures. Same thing. There's a November high. There's a recent low. Forget about these DLs. That carried over from notes on the 60-minute chart. This again is a daily chart, daily candlesticks, and you can see right here. So this would be the 38.2. We had a reaction on that initial tag of the 38.2% retracement. I usually turn off these 23.6s. I usually target between the 38.2 up to the 61.8 on counter trend rallies. And there's the fib cluster, what I wanted to point out. Just like I showed you on QQQ, you have the 38.2% retracement of the entire move down off the highs right there. Blue line, we're exactly where we're at right now on the Nasdaq 100 futures, and a hair below it, the 50% retracement again of this move down. So again, there's no saying the momentum's strong. Everything I predicted weeks ago has come into play. That whole paradigm shift where people would realize, oh my God, the world's not falling or coming to an end. Corporations aren't cratering. We're not in a draconian-like recession. Despite the fact Fed's raising interest rates, which was everyone was going off of, the world's still spinning, and companies are still making money, and people are still packing restaurants and hotels and airplanes. And now, however, so why would I start to be bearish now? Because again, that was, you got to get in front of these moves, predict those paradigm shifts. It's where it's going to peak out is the $1 million question. I don't know, but I think it's going to peak out, like I said, at least before a tradable pullback, anywhere between where we're at right now on these fibs and close enough, like I said, to that downtrend line that I'm not going to milk it. You got a bearish a bearish rising wedge forming in QQQ as well. I showed you the one on RTY, and this is my 60-minute chart. So there's the downtrend line, and again, to me, it's close enough to it. I expect a considerable reaction. There's price resistance there as well, and so I would rather be a little early on this one than a little late. And so, especially again with those longer term accounts, the problem with trying to nail a top with something like a 401k where you only have mutual fund options in there is no matter what time you sell them, between when the market's open 9:30 to 4, if you get your order in before the close, you only get that end of day price. So if there's a big intraday reversal, this little current rally is probably going to end with a little bit of a bang here, I suspect. There's a lot of JCL, Johnny come lately longs jumping in that didn't get the memo early on, or were doubters and now are believers that the bear market's over and it's time to buy tech stocks. And again, like I said, the time to buy Apple, Amazon, all these big tech companies was back here when no one else wanted to buy them, and that's when we were buying them. And so that's when we get here, then I'm a seller of those. And that's whatever. Those are my thoughts. Let me show you the wedge again. Really liking that RTY. Same as IWM here. I'll just start out because I know a lot of you guys don't trade futures. A lot of guys and gals don't trade futures. 60-minute chart of IWM. There's what I gave you yesterday. I don't have all the little micro targets. You can line those up with the chart of the futures. And before you ask, please let me say this. I say it often. There are numerous leveraged and inverse ETFs for especially for the major indexes. Off the top of my head, I can probably count a half dozen ETFs that track the Russell 2000 index or the Nasdaq 100 inverse, one time, negative 2 time, negative 3 time, positively correlated, through 3 on at least each, and then there's other companies offer them. So I can't possibly put up all the price targets. If you're going to go with, let's say, what I'm leaning towards, like on IWM, if you're going to swing it down, you might opt for TWM instead of TZA. TWM has 2 time inverse leverage. It's a negative 2 time ETF, and because we may grind lower here for a while, and even if we go higher, that's the other thing. You don't want the 3 times. The 3 times work best when you get a very sharp, what I call unidirectional move with very few counter trend rallies, and all that matters is the daily candles, not the intraday stuff. It's how they close end of day. I explain that in the FAQ page. I do a detailed explanation, and I've over the years highlighted countless examples, and I have to do that because I've yet to come across an article in the media. A lot of these buffoons write that they're the scourge of Wall Street. They should be banned. They're horrible. You're going to lose money in them. And I've identified many opportunities. I'll tell you when I prefer them and show you that you do better than the leverage factor, better than 3 times or 2 times what the underlying index does if you catch a unidirectional trend. What's a unidirectional trend? Right here, you see that divergent high right there in IWM. That was that last bear market rally back in what was that, May into June. And so right there, you see that that's a unidirectional drop. You had very little kickbacks. You had a little snapback there. TZA, the 3 times short Russell 2000 ETF, would have done better than 3 times a drop on IWM. But this is where you don't want to own them when you're consolidating or grinding around. So look, you can't go wrong. TZA, TWM versus TZA if it drops straight down, because you're going to make a beta adjustment to your position size. In other words, for the small caps, which we're looking at, you have oh gosh, it's on the tip of my tongue. There's a one-time inverse ETF out there. I never use that one. I'll usually use TWM. TWM's 2-time, and TZA is 3-time short, that is. So and the way it works is you're going to beta adjust whether you took the one-time, it's RTY, no, RTY is the futures, the one-time or the 2 or 3. If you short, let's say, IWM, let's just say you short IWM, and let's say your position size on an average trade is $10,000. So on this one, TWM, you're going to take 5,000, right? You're going to take half of what you'd normally short on IWM. And TZA, you're going to do, a third of that, whatever, $3,300, right? And that's how that works. So you just got to try to predict, and if you're not sure which way to go, stay away from the leverage ETFs. I will admit, if you don't know what you're doing and you can't, make a pretty accurate prediction of when things are likely to fall pretty hard and fast with few counter trend rallies, then opt for either the lower leverage or no leverage at all. Is the way to go. But there it is. There's our nice rising wedge. No sell signal yet. Getting close, but and that's why I said today. You can. It's up to you. I'm an aggressive trader. I'm also what I call an anticipatory trader. I anticipate things before they happen. A lot of traders are saying, "Be mechanical. Just don't try to guess where the markets are going. Just mechanical trader will wait until there's a confirmed sell signal." And sometimes I like to get in front of them. It works out sometimes, and when it does, you have a better cost basis, better entry point, and sometimes it doesn't work out. And in the end, it balances out. But I'll only take one in advance if I really think there's a good shot it's going to break down. There's that wedge on RTY, small cap ETF right there. And let me just show you the daily chart of what the small caps look like. There's fib retracement level right there. We're just hair above, and plenty of resistance here. This is a resistance zone that we're in right there with IWM small caps. All right, new trade ideas. Enough on that. You guys know my thoughts on the market. I've been getting those charts out to you. Let's talk about the hooved creatures. Let's start with. Let's go with live cattle. Let me cue that chart up for you. Give me 1 second here. LE. And to the best of my knowledge, if you want to short cattle only or hogs only, you're going to have to use futures. There is an ETF out there that I know of, COW, C-O-W, and that holds hogs and cattle. But I don't know of an ETN or ETF that targets just one or the other. We're looking at 6-month charts. LE is a symbol for live cattle. And what I'm looking at here, you had a reaction high there, a big old gap right there, and so that's resistance. That's right about 144. You can see that says 143.988. So we're going to call that 144, and so pretty much we're at resistance with divergences that have been building here. Again, 2-hour candlestick, 6 months of price history on this chart. You can zoom it down to a 60-minute chart. So this one is also, there's 1 of 2 ways I'll typically short a stock. Either a rally into resistance, which this is, and it's also the top of the wedge right there, and or a break of support, which will be, and that's where, if it does break, I'll add to it. On the support levels, you have price support there about 142.51 and the bottom of the wedge. So again, by shorting up here, if it pans out, and if it doesn't, I like that. I like shorting resistance because you can have a stop not too far above the other side because it shouldn't break the resistance level. But if it does break down, I'm going to just ballpark this. You're going to have, remember, futures are leveraged. So that's about a 1.3% drop to the breakdown point. And then if it breaks, if it plays out, the widest part of the wedge you take, that gives you your measured target ballpark. And that could take us down all the way back down here right there to those recent lows if the wedge plays out. So again, just throwing out trade ideas. You know me, I like to be diversified. I like to spread my bets among as many different uncorrelated assets as possible. Lean hogs has absolutely nothing to do with the stock market. So if my index shorts don't pan out in the next week or so, and this one does, great. If they both don't pan out, then my natural gas, crude oil, gold, silver, something, on any given day will offset losses on another position. That's the whole benefit of asset allocation and diversification. All right, LE again. Targets. Well, obviously the wedge first. I'll follow up on this if it starts to pan out. I'm gonna do more and more updates. If it gets stopped out, then it's stopped out. Really shouldn't go much higher than the recent highs there. There's first price target after the wedge breaks. I'll have to give me a little time to study this one, and I can certainly add some little micro levels here, and I'll zoom down to the 60-minute chart as well to more precisely identify some targets for you. The other one, it's partner in crime. This is again live cattle, and HE is lean hogs. There's HE, 6-month chart. So on this one, it's also an objective short because we had a breakdown today. We had resistance here at 97.93 right there, price resistance, which we ran into the other day or a couple weeks ago. This is 2-hour candles, or just recently. Yep. And we had a trend line break, so broke down, and right now it's back testing. So that's why I wanted to get this one out to you. You can make a case for an objective short on the back test and or another pushback to that 97.93. I prefer it not to recover the trend line. Sometimes it'll back test and work its way up there if it's back testing the trend line. So again, it's all about risk reward. Stops on the other side of the resistance somewhat, and then minimum swing target down here to 92.44 right there, and I'll most likely add some additional targets to this one if it starts to get some traction. I just have to study the chart a little bit here and figure out where to put that line. Okay, and like I said, cow is the only one I know of. The livestock ETN holds hogs and cattle, and that's it. It's you can see I've had a back trend line here for a while. It broke there, gave a sell signal. It's been back testing. It's been bouncing on this support right here, 35.47, which is a potential target if it wants to make another run down at those recent lows. That's a big support level right there, and that would be a nice swing trade down to that level. If that happens to break, not a whole lot of support below there, but let's just target on that for now. It's again thinly traded. Anytime you use a thinly traded, the way to tell, I mean, you can check volume obviously and look up the volume, but when you go to something like a 5-minute chart, a 1-minute chart, and you see these wonky candles, it's because there's very few trades there. So this is how many people do you know, or websites do you know, that'll sit there and talk about hogs or cattle one day and the stock market the next, and then Bitcoin and crypto? Like I said, if it has a ticker, I'll trade it. So there's not a lot of people out there trading this, and so I just want to throw that out there. You got to use limit orders if you're going to use a thinly traded stock, ETF, futures, because market orders, they'll get filled and you'll have unfavorable prices there. Alrighty, what did I tell you would be next? I covered the markets, the hooved creatures. Lumber. Let's do an update on lumber. Hasn't taken off yet, but I told you yesterday when I covered it that we were close to, but not at a divergent low yet. We needed to make a marginal new low. We did that. We've got now the positive divergence. It is still unconfirmed. It needs to turn up. So there's our previous reaction low. This is LB lumber futures 3-month chart, hourly candlesticks. There's a trend line that's quite a bit higher. I just can't make a better one. I don't want to force a trend line there. And so all it is, it's still solidly entrenched in a downtrend, no buy signals whatsoever. But one thing you want to watch for, if it can recover that recent low, see it just slightly undercut that previous reaction low. and you have divergence here. So what I suspect will happen will be a bull trap. So an aggressive trader can take this. This is also a relatively thinly traded futures contract. And, doesn't open till 10. Instead of 10 a.m. It's when it starts trading for the day. Trades up to 4 when the market closes. And they've got a new one coming out. I already talked about that. Either way, you could take a pot shot here or wait for a reversal up back above the recovery, because this whole thing will be a false breakdown, aka bear trap, and that may cause some short covering. And if so, these indicators should turn back up and confirm that divergence, and then I could see a swing all the way back up at least that 575 level. Lumber is a pretty big mover when it moves. I went over that yesterday. I also showed you the positive divergence on the daily chart. If confirmed, I went over that yesterday. Showed you the last 3 times on my daily chart of lumber futures. We had 100. They were 100 to 200% rallies off divergent lows on the daily chart. So something to consider there. All right, what else? The metals and let's go to energy. Excellent sidestep yesterday. Told you we were right here. I said, look, I showed you that down. Looks like more downside in the coming weeks and months, but I said I could see a bounce here. We were at support 7.544, right around coming up that support, and I pointed out the positive divergence. Told you I closed out my short position, and look at that sidestep right there. I just moved the line, trying to measure. Only way to measure on this platform, you got to draw a line, and then you grab other lines that get moved. It was about a 7%, just like the last one I showed you. That was no better. No, what is it? Here, okay, it's not working here. Pull this down from high to low was actually 12%. So, and then look, we went on, and I warned you as well. If we punch that trend line, it's probably going to keep going because you had a nice downtrend line there. So that's the nature of this beast. So you've got to heed those warnings. You see the divergences, a fall to support, and especially breakout of a pretty well-defined downtrend line, and boom. So hope some of you either caught the long or sidestepped that give back on profits on a short, because natural gas giveth and it taketh away. If you didn't heed that warning there, you just watch in a matter of a couple hours, a 12% takeaway on your profits, or maybe put you to a loss depending on where you were. And there's still the longer term charts are bearish, so it rallied right up to this resistance line. I had this same line, I haven't touched it, 8,378. Little momentum fueled overshoot. Tried to then, once you had that spike high, it ran at it once again, and then boom, coming back down. And remember, it's the daily chart, just like crude oil, pretty ugly. There was that recent buying climax, one reason for the last short, and PPO is about to make a bearish crossover. And the bigger picture, just like crude, you put in a big old bearish rising wedge on the daily chart. You had a nice drop, hit support there, counter trend bounce. This is the nature of this beast. It's either full throttle up or full throttle down. There are periods where it'll consolidate, but natural gas is either the widowmaker or the rainmaker, depending on which side of the trade you're on. So, and there was a most recent uptrend line right there. Alrighty, let's go to crude oil on a related note. CL crude oil. This one I've been, made the case too. Longer term bearish. I'm going to go to that 1 year chart right there. We cracked. There's that support about $92. It has now been broken. It was broken here, and then you had a snap. It was an intra candle. That's a daily chart. So that means we went there under that day right there. That was on here. I'll zoom in. I know video, sometimes I get complaints you guys can't see the charts. If you're watching them on your phone, I can't help you there. Watch them on a computer monitor. But there's the intraday break and recovery back above. But yesterday we made a close. So that is a sell signal. That's bearish until and unless 92 is taken out. However, I've covered my short here because look, you've got positive divergence on the daily chart. We may go down there, may take the divergence out, may keep it in place and hit that next target there. But right now, I'm just rather be out of this one. And when you can see on the 60-minute chart too, you have potential divergence as well. Potential because the indicator just made a bearish cross, pointing lower again. They could firm it up, and the traders are going to watch this previous reaction low. So for me, just sit aside for now. If I had to be one or the two, gun to my head, lock the key away for 6 months or 3 months or even a couple months, it would be stay short because of those additional downside targets that I have. But I just want to show you there's some divergences forming, and just like there were in natural gas yesterday, so you gotta be careful if you're short there. Alrighty, let's see. Well, the metals are doing what the metals should do. Pointed out that was that morning I took off, but had the divergences, had a correction, but then I made a point to 8:30 at night to do a video for you guys to tell you that, hey, yeah, there was a small correction priced in, but I'd be a buyer there because we pulled back to the uptrend line, and I expected another leg up, and so far that's exactly what we got. Nice re-entry on gold, just above the back test of the trend line, move back up. However, like I said, we were going to go up, we're going to have divergence. We still do. So what I'm doing right now, I'm going to take this line, about an equal high right there from the previous high, and so I'm taking this line and telling you the divergence is still intact. So you can keep it long. I think gold will continue to work its way up, and quite likely take through these divergences. So I'm still holding out for this 1825 target right there. But what you want to watch, if we roll over soon, that divergence stays intact. You don't want to see this trend line get taken out. And if you do, and you want to hold out, if you're a longer term investor, trend trader, 1767 really is a line that I want to see hold. So anything there, can still, keep that bullish case intact. Don't want to see much more than that. And again, next target's 1824. So they're all doing well. Palladium, same thing. Told you we hit that was really when the third target on the ETF PPLT was hit. And then, as I pointed out, we have that nice uptrend line you pulled back to. So, the divergence, this is what happens in a bull trend. Divergences will either not play out at all, or they play out, but they play out for just a relatively minor pullback. In a bear market, divergent highs, usually the next leg down. Just like in a bull market, divergent low is good for the next leg up. And so far, pretty nice price action. Platinum continues to run. This is PL Platinum Futures. Then it's going to take out that divergence there. Could take it out here. And then Palladium too. Where's PA had a little bit deeper correction, but look at this. Just put in a nice divergent low here. See that little 6-minute divergent low? Boom, rocking it up, but right at resistance now. So this one also standing side for now on that one. Silver and gold, GDX still like that. No change there. The miners are, they're not rocketing yet, but they still look very constructive. I still maintain these targets there. This is GDX daily chart right here. The gold miners ETF. You had a downtrend line, divergence, positive divergence right there. We broke out. We just back tested yesterday, up today. And so if we can get some traction in the metals, the miners should rally up, and you've got your targets. This was laid out a few weeks back. We got in a little bit early, but I haven't waffled on this one. Still holding that. And again, it's one of many positions. Don't fall in love with it. Either works out or doesn't. At this point, you really don't want to see the lows get taken out. If so, you're going to have the divergence probably taken out, and the metals probably take another dive down through that level in gold and some other trend line in platinum that I showed you and all that good stuff. Alright, that's it. Let's wrap it up here, and before I do, let's just take a peek at the equity markets, because I'm seeing things have started to turn since I started the video. There's NQ, the Nasdaq 100 futures, one of my favorite trading vehicles, right at the bottom inside still, but at the wedge, 60-minute bearish rising wedge, and if it breaks, probably coming back down for a nice tradable trade. Could be all the way down. I still maintain my maximum downside targets, and I'll let you know as we go, but that's what I think have a good chance of hitting these uptrend lines off the lows. That's an NQ. You see the same thing in QQQ, and 60-minute chart, QQQ right there. There's the yellow uptrend line. Just move the needle there, move the lines, I should say, that the markers. There it is, divergent high 3. Need to come down here. First target 312.75, 308.40. Little micro targets, short-term targets, and then the Like I said, at this point in time, my max swing target down there, if hit, that's going to be about a good 9% or so drop, 8-9% drop. All right, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.